Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. Today, we have the quarterly dividend payout updates for our conservative portfolio, plus helpful stock and strategy tidbits along the way. This is an update from episode 69 that we did back on September 24th. Since these updates include a lot of tickers and numbers, you may benefit more from watching us walk through our spreadsheet in real time. To watch the video, head over to our YouTube channel or click on the link in the description. That'll take you straight to it. If you're following along with our more aggressive portfolio, that'll get covered in the next episode. We also wanted to let you know that this will be the last time we cover these updates on the podcast. Going forward, they'll be available on our YouTube channel. Subscribe over there to get notifications. So now, let's dig into the numbers.
So, what up, y'all? This week, we are going to go through the retirement portfolio and do the dividends for the last quarter like we promised last week. I know it's going to be a bunch of fun stuff, so we get to see the fruits of our labors. And if you've replicated any of the things that we did, your fruits of your labors should somewhat resemble this, hopefully. If not, then you did something wrong.
You said retirement portfolio, right?
It's the retirement portfolio. Next week is the
van life one.
Van life, living by the river. So, we're just going to go through them item by item, and then I'll explain what's going on, and it'll be fun. First one is JEPQ. That's the tech one that does covered calls. I should emphasize that the ones on the left over here that are bolded, they're overvalued, so don't buy them right now. And if you own them, you should probably consider turning the drip off of those because they are overvalued. So you're getting your reinvestments back at a higher rate than you want. You just want to get it in cash, and then you can put it.
Into bullet shares.
If you get it in cash, you can put it in these other ones that's undervalued, that's not bolded.
Or that, yeah.
Whichever way you want to do, or you can put it in bullet shares and just start a cash fund for whenever things go on sale, which they will next year at some point. They always do. It's not a straight line up. It kind of goes like this. So you can buy down here with your cash and then be good. Okay? Make sense? All right. First one. JPQ. It yields 9.56%, which is that's an obscene amount of money for tech stocks. If you've been researching or looking into what tech stocks pay dividends, it's normally like in the 0 to like 1.5%, maybe 2% range. So the fact that you can get covered calls on a lot of tech stocks like Amazon, Nvidia, Oracle, things like that at 9.56% is crazy.
Cray.
I have the buy up to price here of 54, and it's vastly overvalued. It's overvalued by like $2.68. So that's why it's bolded over here on the left. You don't want to be buying this one. You don't want to be reinvesting your dividends unless you're just trying. And like in our case, we reinvested dividends because everything we've already got our initial out, back. So everything's just profit at this point. So we just have the drip on, and I just forget about it.
Yeah. So once you hit that recoup period, you can leave the drip on, and then it's kind of a set it, forget it, unless it becomes ridiculously overvalued or the metrics of it change and you decide you want to get out completely.
And you'll see here, it's a variable one. You can tell it's a variable dividend by these three amounts here. With September was about 119, October was 119, and November was 108. So it's not a consistent dividend, but it is consistently high. It's like it's in the 40 cents, 40 to I think 45 to 53 cent range every month per share. So that's super awesome. So that means we got $345 and some change for the quarter. We have year to date of about, I guess that's $11.52. And we've actually added 21.607 shares throughout the year to a fund that we don't have any initial investment in. So this one is tight, yo.
That's phenomenal. That is like the power of compounding.
Yes. The second one is XYLD. Again, overvalued. It's barely overvalued, though. I have like a buy up to price of 42, and I should clarify my buy up to price is not like you see if you have other publications where they have like a target price. My buy up to price is where you don't go over that because you're not going to get like a high yield. You can obviously buy at 44 if you want, but your yield's not going to be 9.38%. It's going to be somewhere in the like 7.5% to 8% range. So if you're comfortable with that, you can, by all means, you can go above my buy up to price. But I had a lot of people ask, well, where to start and how to start. So I figured I should have the buy up to price so that you can just look at it and be like, okay, I can get in that one. I can get in that one.
So that's basically to help you guys know like where Tim wouldn't get in.
Right. So XYLD, a covered call that writes covered calls on the S&P 500. So like this first one here, JAPQ, is like pretty much the NASDAQ covered calls, if you want to like simplify it that way. And XYLD would then be the S&P 500. You're getting 9.38% on an S&P, like basically index fund, for the lack of better terms. So that's, again, ridiculous amount of yield for basically an index fund. When you look at the normal index funds, they're between 1% and 3%. So you're getting
so low.
a lot more dividend yield. We collected, this one's, again, variable. It varies month to month. Some months is 37, some months is 42, stuff like that. But we got 86 in September, 98 in October, and 95 in November for 279.32, which bumps us up to a 1,031 for the year. And we've accumulated 25.148 shares total in this one for the year. So again, we're just
not too shabby.
Just compounded upon compounded. You have to, so if you look at what we're doing here, the 25 doesn't seem like a lot, but like I just said, this is like, so say it paid a 40-cent dividend, you're getting, what is that? Like, you're getting like $2 extra a month just by letting it compound. It's crazy. Like,
yeah, and then that compounds on compounds and compounds on compounds. So that $2 turns into $3 after not so long, and then that $3 turns into even more. It just depends how fast you compound the shares. And
so that's like those two right there. Like, if you're just starting out and you don't want to dump your money, like something like this would be a good idea. Like, there's so many different covered call things out there that you get a really good yield, like between 8 and 10% yield on something that you shouldn't be getting a yield on that for. Now, the drawback to these is, again, there is a upside cap. Like say the NASDAQ takes off and goes up 4% one day. Well, the JEPQ is only going to go up like 1.5 to 2%. And I'm okay with that. We're doing income investing. We're not doing growth investing. So like, I'm cool. Like, if you give me 2% gain plus a 9.5% yield, I'm cool with that.
Yeah, because again, our strategy, growth stocks you have to sell to like get any amount of money, but then you can divide it up and it's one and done. With the dividend stocks, it's monthly income. You're building that monthly income. So you can do growth stocks. We do definitely do growth stocks.
I have growth stocks.
But time and a place, and when you're getting started, it's probably better to focus on building the dividends.
Yeah, the growth stocks aren't in this chart because there's no dividends. So but we have Planeteer in this account. We have SoFi. They're both growth stocks. And I'm not going to include them in like an income.
Yeah, that doesn't make sense.
It doesn't make sense. But like, we have sprinkled throughout the portfolios are a few growth stock ideas. And when I do the 2025 prediction, which will be on the 20th, I actually have a bunch of growth stocks on those that should perform quite nicely that aren't going to be included in these charts that we actually have money in now. And if you've subscribed to the email, you got early access to a couple of them. So next one, ABR. I've been talking about ABR for years now. So like, if you're not familiar with ABR, it's a real estate trust that invests in mortgages and like physical properties. So obviously its yield is going to be super high. You can see it's 11.62 here. That's actually a lot lower than when we got in. We got in at like when it was like $8 or $9. So it was yielding like 15%.
Nice.
So it's 11.62 at the current moment. Buy up to price is $15 and it's $14.80. So it's getting pretty close to that point where you might want to consider not buying it, or if you're in it, turn the drip off, because it's like overvalued and you can wait for
you could put your money somewhere better.
There'll be a pullback again at some point. So you wait for it to drop down to like $14 and then turn the drip back on. I actually just did that with Hercules Capital. We'll get to that in a second.
Yeah. And the reason that we do so much, like, I guess like micromanaging would be the word, is because if you want your money to be making the most amount of capital that it possibly can, especially when you're in the beginning, because it's going to compound your actual profits and your dividend payouts so much faster.
And if you look at the sheer size of this portfolio, the portfolio's...
I was going to say, what are we at now?
Ridiculously huge. It's like... So 30, like we have 39 holdings in here. And
that are dividend payers.
You would think that would take forever to actually like monitor. It doesn't. Like, it actually goes pretty smoothly and pretty painlessly once you actually get this column started here, where you start buying them and you start monitoring them. Like, you start with like 3 or 4, and then it'll become 5 or 6 or 7. But you'll become familiar with them. Like, I know where this should trade, so I don't have to worry about looking up anything. I check in like once a quarter to make sure the profit margins are still good and that there's the debt's going down and things like that. But like for the price band, I'm pretty familiar with Hercules Capital because we've been in it for like 4 or 5 years.
Yeah.
So once you become familiar with it, it becomes so much easier to like monitor your portfolio without actually do time-consuming, tedious process.
Yeah, like I would consider this, like, if you're a people person, each one of these is like a different friend. And you know when one of your friends isn't acting normal, like, you just know because you've been around them so much, you've had so much exposure. It just becomes part of the territory once you start doing this. And it's like anything else. You start small, You figure out what you're supposed to do, and then you can scale up once you understand the premise.
Mm-hmm. So for Arbor, we got 152 in November, and that brings us up to 554 for the year. And we've actually added 40 shares because Arbor was so volatile in 2024. There was times when it was like 11 something, and there was times it was like 13 something. So we've actually accumulated a lot of shares of Arbor this year.
40's a lot more than the 20 and 25 from the other two.
Next one is one we just mentioned, Hercules Capital. It's awesome. That's all I have to say about it. It yields the same as Arbor.
I was just going to say, look at that, same yield.
It's 11.62, and in my opinion, Hercules Capital is far superior to Arbor. So that if you were just starting, this would be one of the first ones you should start with, Hercules Capital.
We've been saying that for months and months and months.
I've been years. Been saying it for years. Buy up to 1950. It's trading at 1890. So but this one's actually been in a band where it's trading like between 1850 and like 22. So it's like at the bottom. It's at the bottom part now at the 1889.
Best time to get in.
With Hercules Capital, like right now, I turn the drips on because it's down at the low part of the band. Like, you know what I'm saying? Like, it trades between 1850 and 22, and it just keeps doing this. So when it gets up here at the top, like in the $21, $22 range, I turn the drip off, and then when it falls back down here, which it inevitably does in this area here, I just turn the drip back on. Like, it's simple. I mean, in Schwab, it's simple. I don't know about other ones. Vanguard seems impossible. But Schwab, it's so easy. Like, you just pull up your positions, and it has a column that just says dividend reinvest. You click on it, and you can hit yes or no. It's super simple. It's one of the reasons I like Schwab. And when we discussed that,
Vanguard is definitely not for dividend investing. In the brokerage episode,
like Schwab's the best in my opinion. But in fairness, I don't have Fidelity yet, but we're going to get a Fidelity at some point, and I'll see if it's comparable to Schwab.
Schwabby.
Okay, so Hercules Capital, we made $233 in November, bringing us up to 931 for the year. And we've like you can see here, we dripped 12.174 in November, but that's all we've made in the year so far is 12.174 because it was trading high. So I waited till it dropped back down, and I turned the drip back on to accumulate more shares. What it does, it gives you a bunch of cash. You're looking at like $225 in cash, and then just dump it into something else that's undervalued. It's awesome. Strategy works, except for the next one. Next one's IEP.
Oh, this one has been just like the bane.
We discussed this one. I don't know if it was last episode or episode 4, but like they basically cut the dividend from $1 to 50. So they cut the dividend from $2 to $1 last year, and then they cut it from $1 to 50 cents in the same year. I don't have a problem with the dividend cut. I'm not happy about it, but the rationale for the dividend cut was so we sold
majority.
Out. You can over here we sold out in November.
Are we completely out? Oh, this is the retirement portfolio.
November 8th, we just got out of IEP completely because of that. Like they're not doing business, which in my best interest, so I'm not going to hold them anymore. But we do still have half our position in the Van Life one, so that's nice. Buy up 2 points. It yields 18%. Even with the 50-cent dividend, it's still 18%. Buy up to 1575. It's currently trading for 1107. So there's lots of wiggle room there. Like you can buy at any point that and make lots of money.
I think we should do a full case study on IEP at some point to like summarize the whole thing. I think that would be helpful.
Made $332 or about $333 in September off IEP, which brings us up to $1,160 for the year. And we actually dripped 75.617 shares.
That's what I'm saying. This thing is accumulating so many shares, which is how we keep getting oversaturated in the freaking portfolios, which is why every time it freaking tanks the portfolios so hard. It is ridiculous.
So like once I sold IEP in the retirement portfolio, it became much less stressful.
Yeah.
It was like the last of the...
And again, the reason for that in the retirement portfolio over ours, my mom's portfolio is more about capital preservation. So if that thing keeps cutting dividends, dropping a cliff, like it's too risky for that. I
do believe in 2025, IEP will have a fine year because most of its stuff is American products and Trump's American stuff. So IEP should have a good 2025, but I'm not willing to take that risk in the retirement account.
Not after what it's done.
Next one, MBXG is another tech fund. Again, overvalued, just like JAPQ. $13 is what I would buy it up to. That gets you 9.14% around there. And it's currently trading at $13.13.
So it's just a smidge over. And the yield right now is 9.14%.
So we got 61 in September, 61 in October. 60.73, 61.20, and 61.68. So it's gradually bumping up because we have the drip on still. I'm probably going to turn the drip off, not this month, maybe next month, because it's just continuously gone up. It's up so much for the year. It's up like 40-some%. Or no, 75% for the year or something like that. It's
I was going
ridiculous.
to say, look at that share reinvestment.
So we've made 183.61 this last quarter, and we've made 652 for the year. And we've actually got 53.237 shares. So when you're making, like, the reason that I don't have a problem, like, turning the drip on and off is when you're making 50 shares a year or 75 cents a year.
Shares.
It's not
crazy.
Very difficult to turn the drip off. You've made more than enough to like
recoup your original investment.
Get your income up for the
Yeah.
up for the month or the quarter, whichever the case may be. I really like MBXG. I believe this one is going to perform better than JEPQ in 2025 just because of the holdings and what they have going on. This one's not really a covered call, whereas this one's a covered call. So that's why this one's up. Like I think MBXG is up like 25 to 30% more than JEPQ, and that's because it doesn't have the covered call. It just holds the stocks of the companies and pays you a dividend. So that's why it's 9.14. So it's a little bit less, but I like it.
Look at that share compounding. It's like double.
They do use leverage, but that's different than covered calls. But next one's SBLK. It's a shipping stock.
Not to be confused with Black Hills, right?
Yeah, it's shipping stock should be fine in 2025. So if you hold this and it's been a bumpy year, it's only up like 5 or 6% for the year. It was at one point in the year it was up like 25 to 30%, but you're collecting 14.25 dividend. So that's cool. It's currently at 17.55. I have 22.50 as the buy-up point. If you do 22.50, you're going to be still getting like a 12% yield. So that's good. 182.43 in September, which brings us up to the devil's number. And for the year to date, 666.
It's like even too. That's hilarious.
And we've actually did a drip of 30 shares.
That's a good bit of share accumulation, even for something.
So that one's a definite buy. Like if you have money sitting around, like you should probably like consider shipping stocks. It doesn't have to be this one in particular, but you should do a cursory Google search about what best shipping stocks to get dividend wise, and then look at the financials. I just like how this one has a better profit margin than a lot of the shipping stocks, and the profit margin to me is super important. That means
they can pay.
That when they have the profit margin, that means this here shouldn't be cut. The dividend yield. Profit
that means
margin,
they can pay.
Yeah. Okay, next one's Trinity Capital. We've been talking about Trinity Capital for 3 years.
And it just keeps running.
This one here is another one that had an up and down year. Like it was as high as like 1570.
Well, what I find crazy about Trinity, like you're like, it just keeps going up, keeps going up, keeps going up. But I don't even think it's that high of a share price even now. What the heck was it at when we started?
We went up to 1570 and then it dropped back like from like August on. So it was going up, going up, going up. And then you can see it drop.
But that is another cool part. Like when you get in the lower share price stocks, when they move like pennies, the percent increase is like so much higher than say like $1 up in a $50 stock.
Trinity yields 14%, and it's currently trading at 14.48. 14.50 is about as high as I'd go right now until I see some semblance of why it's dropped like $1.40 in the last couple months. So this one here is probably a hold if you have it.
It's probably like consolidating.
Keep your dividend on and then see what happens. That's what I thought consolidating, but you look at the chart, it like peaked.
Was there
any
news?
And then it started doing this here where it started going down. And so like it was doing lower highs. So like it doesn't seem like it's consolidating as much.
What was insider trading doing?
They're holding it.
No, okay.
And all the
sentiment could just be stupid.
And all the things I've seen said it's still a hold. One aspect that's bad is it's like 12% overvalued compared to like all the other BDCs. But
we kind of have been saying that for a while, which is why we were taking shares off the plate.
If you remember, I've sold at least 4 times in the stock.
Yeah, a lot.
And we still have so many shares to make. What is that? $193.50.
Like that's a lot. So
and 764 for the year.
Do we have our full investment out of this one yet?
Oh, we're about 20 shares short.
So right there. So even if it does drop down, as long as the metrics and everything are still good, it's just a sentiment issue. It'll bounce back, and then again, you just let it ride and compound and whatever.
Yeah. So for this one, I need to actually highlight this so I can see it. We've made 26 shares up on drip this year so far. So again, this is another one where the shares add up quickly. You can see it, but with the 26 here and the 13 here, there was one quarter where I took the dividend in cash, and that was when it was trading like $16 a share. I said, oh, that's too high, so I turned the drip off, but the drip's back on. Okay, next one, Queer Tip. That's a one Queer Tip. It's a $100 preferred share. It's currently at like 43.88, so it's like 56% undervalued, but I have a buy up too. of 45 just because the way it's been trading, it's been in a band where it's been trading between like 38 and 52. So don't pay more than 45 for it. If you have it and you're in Schwab, you can actually just leave the drip on. If you have it and you're in Vanguard, it doesn't reinvest them, so it doesn't matter. One of the quirks between the two brokerages that we use, Vanguard doesn't reinvest preferred shares, whereas Schwab does.
So that'll be different next week for ours.
Yeah, this one yields 18%, and we get 296 in September, 888 for the year. We got in cash, and so we're going to get another 296 here in like 4 days. That'll then go into something else.
Woot.
Next one is overvalued. And that's only because
UAN.
Current. This one was trading in like, I think it's coal. Isn't it coal? I think it's coal. I'm pretty sure it's coal. Or no, that's our ARLP. This is fertilizer. This is fertilizer.
Oh, fertilizer. Yeah, this is okay. This is the fertilizer one. That's right.
This one was trading about $68. And then Carl Icahn disclosed in his 13Fs. If you're not familiar, 13F is whenever you're an institutional investor, at the end of every quarter, you have to disclose what you buy and what you sell, and that's what they call 13F. Carl Icahn disclosed that he increased his percentage by like 10% in this one, so it like shot up.
It blew up. Like it literally went from like I think it was trading at like 65 up to 75 like in 2 days. So this one's just recently overvalued. And when we say Icahn, like we're talking about IEP's like CEO dude.
So hilarious. It yields 8.83 now at 75.77, but 72.50 is my buy up to price for this one because that'll give you 9.5%, which I kind of like, between 9 and 10% for most of my investments.
Okay, so now it's overvalued. How long do you think that'll take to come back down?
It should come back down over the winter, and then it'll pop back off in the spring.
Because fertilizer sales will go up.
So we only made 68.67. Again, this is a variable dividend. Like what they do is with their profits, they just decide, I guess, randomly out of a hat. I don't know what they're going to pay.
You mean there's no rhyme or reason?
Sometimes it's like $3, $4 a share, and other times it's like 91. Like the last one was only $1.19, so it like went from $4 a share. They
probably have some formula.
The quarter before to 119. So we only made 68.67 in November, which brings us up to 371.28 for the year, and we have reinvested 5 shares of this one.
That is puny compared to everything else.
I won't mess with the drip on this one until like January or February until I can see what's going on, because that's when the next dividend's coming out.
Yeah. Next
one's one of my faves. My favorite way to play the AI right now is this one. For now. That soon's going to change because I think I'll show you when we get down here at the bottom. NVDY, it is the yield max covered options trade for NVIDIA stock. I keep saying that wrong. NVIDIA stock.
That's
easy. It yields 73.5%.
Jesus Christ.
It's overvalued currently. I wouldn't pay more than $23.50 for it. It's at $24.80.
And you really have to pay attention to the yield max ones because they can drop a lot because volatile. Of the way they're structured.
They're volatile as hell.
So heed that buy up to price.
But we've made 89.30 in September, 77.10 in October, and 74.89 in November, 241.29 for the quarter, which brings us up to 1,161 so far in 2024, and we've reinvested for almost 46 shares.
Dang.
This one adds up quickly.
Yeah.
I've actually turned the drip off, so that'll be what we make for 2024. The drip's off on this one. I'm just taking it in cash.
Yeah, because again, I hit that over.
Because I'm doing other things. I'm putting money into other things, which we'll get to.
Yeah, we like to turn the yield max drip off a lot of times to funnel the cash cows into
because they pay monthly.
Yeah,
and they pay like ridiculous amounts. Like the next one's YMAX, again overvalued, and it yields 63%. And this is a weekly one. You get paid every week with this one, so it's a pain in the ass to actually keep track of how much you make because you have to add it up for like 4 weeks. But whatever, you guys are worth it, I guess.
That says a lot coming from Tim.
18.35, what it's currently at. I say anything above 18, you shouldn't buy it. And if you currently hold it, because we've been talking about it, turn the drip off because it's overvalued at this point.
Again, YMAX 100%. Turn that drip off. It's overvalued.
We made 91 in September, 168 in October, and 153 in November. For 411.21 for the quarter, we made 909.21 so far, and we have reinvested 31.115 in this one. So this one is another one, adds up quickly. So like you can actually have the liberty of turning the drip on and off because you get paid every week for this one. So this one I play with the drip a lot based on this over here, the share price. Next one's a new one. This is one that we literally just picked up in November 6th.
Yeah, so YMAX is the one that has all of the yield maxes that are available rolled into like one kind of like an index fund. And the next one, Y Mag, is basically the Magnificent Seven.
So it's a new one. I saw how well YMAX was doing in the current environment. I said, let me try this one. So we only put I think $2,000 into YMAG. It only yields 51%, loser.
Only.
And this one here, you could probably buy. I think you could probably buy up to 20, but I put $19.50 just to be safe because these start at $20. So anything over 20 is maybe I shouldn't buy it.
Sketcherific.
But we made $47.15 in November on this one.
Is this a recent buy?
Yeah, bought it at 11.6, so that's only on with.
Okay, so that's why there's one. Okay, that makes sense.
I think that's 2 dividends.
I was like, does this pay quarterly? What?
And we got 2.421 shares so far in November from YMAG. But this one here, I'm keeping track of. I looked at the information that they've had out. It's been out for, I want to say, 8 months. And it seems like it's doing quite well. So I said, I'll just try it out. And so far, it's been quite nice. We got it at 18.05 or something like that. So the price has appreciated in the last, not even month, the last 3 weeks. So next one, blew by it. Next one is YYY. Now, if you've listened, if you've subscribed to the email, I sold YYY in the van life portfolio, but I've actually kept it in the retirement portfolio.
Interesting.
It is overvalued.
Why is that?
I kept it in this one because it does quite well.
Okay.
She's making $50 a month. It yields 12%. It's a little bit overvalued. A buy up. I think it's overvalued, but you can still do up to $12.50 for a 12% yield. When we got into this, it was yielding closer to 17%. So we've lost 5% in our yield throughout the 11 months we held it. I think a more realistic price for YYY is in the 11 to 11.50 range. So I think it is about 70 cents overvalued. I have the drip still on because why not? It's like I'm saying, she's making $48, almost $49 a month. She's made $144, $45 for the quarter, and $460, $56 for the year, and she's accumulated almost 43 shares in 2024 so far. So I'm just going to let this one keep compounding, kind of like I did up top with JPQ, until I absolutely have to turn the drip off or consider selling it. Because if you look at what they're holding, there's a possibility this could run up to 14, even though it's overvalued. Same with PDI, which is in the same email. I said I put a limit order in for PDI in the other portfolio, and we actually hit the limit. We sold that one for the exact same reason. It's overvalued compared to its historical data.
Was that one a lot more overvalued than YYY?
Oh, yeah.
Because that's why I was going to ask 70%. Why you kept YYY over PDI, because I knew you liked PDI better. So that was way more overvalued?
Way more.
Okay.
Next one is AFG. If you're not familiar, it's an insurance company.
Every time I see that, I think of agriculture.
This one was trading at 105 3 months ago. It shot up to it shot up to 150 and came back down a little bit. Anything above 130, you should just avoid this one. It doesn't yield a lot on paper. It says 2.16. But this is one that pays a special dividend at least once a year. And the special dividends are in the $4 to $10 range.
Yeah, so anything that has a really low yield seems out of character for our stuff. Either there's a special dividend or it's actually a fund or something in an actual sector that we think is going to blow off. And it's the only way to really get into that thing with a dividend at all.
As you can see right here, if you look further in this chart, here is the quarterly dividend, $19.50. And here's what we made with the special dividend they announced,
that's a lot.
$98.11.
It's a lot.
So that's what?
Way.
Five times more. So it's
much.
10% yield on the special dividend. So we hold this one just for the special dividend. I don't know if that's smart or not. I'm not here to tell you if I'm smart.
How long have you held this?
I want to say almost a year.
I was going to say time should tell. I think a year would be enough data to.
So we accumulated 118 so far in divvies. 118 for the quarter, 320 for the year, and we've actually accumulated 2.4 more shares of this one. And this one's probably going to be just hold it forever because it's insurance and old people need insurance. So I'm probably not going to sell this one anytime in the near future.
I mean, as long as it keeps shooting out those special dividends. That kind of sucks that the share reaccumulation is so small, though.
Next one is the largest BDC. I don't know if you guys...
ARCC!
I don't know if you guys listened when I said that before, but this is the biggest BDC by market cap and money.
And we do love it.
I do, but I don't like it as much as other ones. But it's awesome.
But it's still good.
It yields 8.7%. buy up to is $22.50. It's currently at 22, so you have a little bit of time to get into that one. We made $133.24 in September, and that was for the quarters, and we made $391 for the year, and that got almost 19 additional shares in this one. So this is one that, again, I'll probably keep the drip on until I absolutely have to turn it off, because I am accumulating a crap ton of shares every quarter. Mm-hmm. I mean, 6 doesn't seem like a lot, but 6 is a lot for as little money I have in this.
Yeah.
Next one next BDC we actually sold in on November 4th is Capital Southwest CSWC. It does yield almost 11%, but it's vastly, like I say, buy up to of 25. That's so you can get a 10% yield. But this one should be in the $21 range, and it's currently trading at $23.35. So it's $2 overvalued. So I got out of it. The last dividend was $39.27. Which gave us $113.84 for the year, and only 4.4 shares accumulated for the year so far. We only had, to be fair, $1,500 in this one, so that's why the numbers are so low.
You couldn't have much in that.
So that is that one. If you have that one, turn the drip off at the very least. Or sell it and put the money into something else. There's other ideas. Next one is one specifically for 2025. It is a closed-ended fund, NLR. It doesn't yield 3.59%, but it holds 26 of the uranium and nuclear stocks.
Okay, so this is the nuclear play.
And nuclear is going to be, like, this is probably one we're going to hold for at least 5 years.
And I think we've said this before, but we'll reiterate it here, where we talked about AI and how AI needs a ton of power. And we weren't sure what was going to happen with that, if they were going to cap people's electric usage. Well, so what's been happening? The big wigs, Facebook, Google, what was it? Amazon was the other one or something?
Microsoft, Amazon, Google.
Start buying up nuclear power plants to make up for the excessive needs for the AI technology. So NLR is the only way to get into nuclear with dividends. And what's really cool about it is you get access to or exposure to 26 different nuclear stocks.
So the only drawback to the nuclear funds that I've seen is you get one dividend per year.
Yeah, this is
It comes in December, but I'm not really concerned. Like, this is what I'm not too concerned with for an income perspective, because I know that this 93.80 is going to be probably $200 within the next couple of years. So it's going to be a lot of price appreciation.
The dividend is icing on the cake.
It does yield 3.5, and like they just announced their dividend that's coming out in a couple of weeks as $3.62.
That's a lot.
I mean, it's still only like 4%.
I was just going to say the stock is $100, so I guess it's really not.
So it's pricey, but in my opinion, there's other nuclear funds out there, but this one, just what they're holding it's far superior to the other ones.
But if you compare this to a lot of the aristocrats dividend stocks, they pay 4%, but they don't have the growth ability because they're already overvalued most of the time. So you're going to get such a better return with this one, considering nuclear is going to pop off. Rocket ship.
Next one, Triple M. Shouldn't need to really discuss this one too much.
I thought we got rid of this one.
I was thinking about it. I've been back and forth about this one. It only yields 2% because they actually did cut their dividend for the first time in 60-some years last year.
I cannot believe they gave up king status for freaking...
But ever since they cut their dividend, it was trading at $92. Now it's up to $132, so it's went up like 40%, almost 50% since they cut the dividend.
Is that normal?
No. But people must have liked what they did. They cut the dividend for the balance sheet.
They must have done it for some kind of growth stuff.
Now they do rebuy their shares. So that's 2.11% is actually not the whole picture. They buy back shares. So like it's more like in the 5 to 6% range if you include share buybacks.
Well, that kind of makes sense, because if you're taking shares off the market, you're actually reducing the pool. So then you're actually increasing the value of the shares too. Scarcity.
We only made $31.30 in September, and we've made $186.47 for the year with not even 2 shares reinvested for the year. But that's because it's so damn expensive. Like this one, I wouldn't spend more than $120 on.
And I definitely recommend, if you're starting, don't even worry about Triple M.
You can find closed-ended funds that hold Triple M. If you're
don't even worry about it.
Next one, I think, is on its last leg. By last leg, I mean probably in the next 5 years, this one's going to be obsolete. Because
it's always been AT&T. Verizon, AT&T.
Verizon's
guess what? Both of them are going to be erroneous.
Really, it has a really good yield of 6.11%
for now.
Trades at $44.38 as of the 30th. All these numbers for the current price are $11.30, and I wouldn't pay more than $42 for it because that'll get you like 6.25%. We got $89.60 in November, which brings us up to $345.03, and we've got 8 additional shares. The reason why we brought this up was the last podcast before, but like Starlink is going IPO soon. When Starlink goes IPO, Verizon, AT&T, T-Mobile, they're all obsolete technology. And so this is going to start going down. So this is one, if you own it, you might want to start taking profits.
Yeah, be wary. So CCI is that one with towers. Like we need to consider that one as well, because if the infrastructure is unnecessary.
Well, we don't own it, so.
Did we get out of it?
Yeah.
Okay. I wasn't sure if we did or not.
So.
I'm not balls deep in the portfolios like you were.
Just saying, like, if you own this, you need to start cultivating an exit plan.
I should probably tell my friend about that since he's so AT&T heavy.
Yeah. Next one we got out of on 9/27/24. ExxonMobil only yields 3.37%. It's currently at 117.66. Now, ExxonMobil will have a good 2025 because it's primarily an American company. So I think the buy up to point was probably going to go up. Well, it's 120 now, but I could see it going like up to 150, 160 range. But to me, 3.37 is not worth it because you'll see the one right below it.
I was going to say, we sold ExxonMobil to buy the one below at Civi.
So we made $59.91 in September on this one, and we had this one for a year. We only got $178. We only got 1.6 shares. So to me, I was like, all right, I gave it like a year to see what happened. The price appreciation was decent. We got it like $93, $94. So we had a pretty good bump up, but we weren't making enough income for my liking. So I researched and I found the next one, which is Civi, CIVI. I like this one
a lot.
And we have another one down lower in the portfolio. It's EPD. So we have the oil
energy
sector covered. So we don't really need this
Exxon.
Pathetic 3.37.
Swill.
Because Civi yields 9.66, and it's severely undervalued. Like 60 is not even like the target price for the experts. They're saying like $78 to $82. I just say 60 because that'll get you at least 9%. But if you buy it now, you could ride this the whole way up where you're getting like a 25 to 30% price appreciation plus a 9.6% yield. We get our first dividend in this month. And what Civi does is they pay a 50-cent flat dividend. That's something like it'll raise. It'll be like 51 or 52 next year. But then they have a special dividend. If they have extra money, they pay a special dividend. It's normally like $1. But this one coming up is only at 50 cents, but it's normally like $1.62. So this is another special dividend where this 9.66 isn't telling the whole story. But
can't wait to see what that thing produces once we actually get some data in there.
Next one is a pharma stock. It's a female pharma stock. It basically just deals in female health, which
that's probably a pretty big sector.
It's a huge sector. OGN, we've been in this one for...
OGN makes so much sense.
We've been in this one for over a year. It yields 7%. And the buy up to price is at least $19.50. This again, the experts are saying $28 to $30. So this is again, you're going to be able to get like a 25 to 30% increase if you buy this with a 7% yield. We made $51.57 in September, and we've made $152.58 for the year, and we've reinvested 765 shares. So that's that. The next one on the list is probably the next one to go. The next one I'm going to put a limit order in to sell. I was just looking at their profit margin. Their profit margin after their last earnings went from like a 8 to 12% profit margin down to a negative 43.
Holy hell, that's a drop.
They're not going to be able to afford this 7.89% dividend without borrowing money.
And then that is just and
it's overvalued to begin with. Like
downward spiral.
34. So like don't get into this one. It pays a lot. For sure, and it's a tobacco stock.
But if you look at that current price of $37.94 and the buy up to of $34, like that, I can see why Tim's saying that's next to go.
I'm just saying it's next to go because its profit margins went from positive to ridiculous negative. Yeah. We made $109.64 in November on this one, which brings us up to $391 for the year, and we've reinvested almost 12 shares. So it's done well for us, but there's certain metrics I look at. Profit margin is one of them because I want them to verify that they can afford their dividend. If they can't afford their dividend, they have a few ways to generate money. One of them is to borrow money, and the other one's to issue more shares, which then makes your share price go down because they're diluting the share.
It's the opposite of the buyback we were talking about with Triple M.
So like they're either going to have to borrow money at like a 7% or whatever interest rate, or they're going to have to add more shares to the market. So this is
it's going to go down.
This is going to come down. Yep. So that's why this is the next one on the chopping block.
Yep. Basic economics.
Next one, I'm not sure what's going to happen in 2025.
IIPR. Okay, this is the marijuana one.
This is a REIT that specifically deals with marijuana, like housing and land and things of that nature. IIPR. It yields about 7%. This one's been ridiculously good for us. Well, we made 114 in October. We've made 436 for the year to date, and we've only reinvested 2 shares. We've only taken the dividend reinvestment once. The other 2 times it's been so high priced. Like this 109.17 is probably 25 to 30% lower than it was before the election. Before the election, it was up in the 138 to 139 range. It was rivaling Triple M.
It was really high.
So I don't know what's going to happen with this one. I have a buy up to of 125. That way you're still getting 6.5%. But if you can get into it before the 125, or wait for it to drop. It might keep dropping. I don't know. Like this, if you're interested in this one, just watch it. If it falls below 100, it's definitely a buy. We got it at $89, and that's why it's never going to be sold, because we got it for like dirt cheap. Unless it falls, if it falls below 89, then I'll probably think about selling it. But that's why I'm taking it in cash, because I'm actually
I imagine if it
money.
falls close to that, that's when you turn the drip back on to accumulate at the lower price.
Next one is another healthcare stock, a BMI, Bristol Myers. It only yields 4%, but we got this at a steal. We got this in the 30s, and it's up to 59.27. Like the buy up to is 50, so don't buy it. If it falls back in the 30s, then obviously buy it. But like this is a really good one for us. We're up a ton on this one. We made 59 in November. We've made 168 for the year, and we've reinvested only 3.4 shares. But the price appreciation on this one makes it worth holding. The next one's another 4% yielder.
That's the Black Hills one.
Yeah, Black Hills Electric, BKH. It only yields 4% as well. But again, we got this one in the upper 40s. So we've made $15 in price appreciation, which is like 33%.
Yeah, that's a lot.
This one is actually, I'm torn. The 61 I think is low because it's primarily an electric one, and it deals with the Midwest, like South Dakota, North Dakota, where there's going to be nuclear power plants that are going to need electricity to run them.
So your foresight.
So my foresight saying that the buy up to price in this one's probably going to be in the $80 range.
Have they talked about plans for that yet, or is that just something you know that's probably
I just know it's coming from where they're located.
All right.
So this one, if you want to get into it, you could. I wouldn't go above where it's at now, basically, because you're still only getting 4%. But it's done okay. It's like for income, it's done okay.
But I mean, with that interest rate, the nuclear one is about the same. And I think that one's going to run more.
Yeah, so that's an option. But like, if you want to have exposure to like a less volatile sector that's always going to have profits, then you want to get into electric, not water or renewables or solar or wind or anything like that. You want to be an electric, and this is a primary electric company. Hello,
Zoo.
We only made not even $39 in September, and we've made 153 for the year, which gave us 2.7 shares. So this one's not a huge share accumulator, but we got it so cheap that it's like, all right, steal. Next one's another prime example. It's another electric company, ES, only yields 4.43, but this one has way more room to grow. Like the experts are saying damn near $100 as their target price. So it can go up, what is that, 36%. So I say a buy up to of 770 because you're going to be getting 4.25 at least. Again, we haven't made a lot in this one, only $50 in September, 118 for the year, and only 2 shares. But we got this one damn near the same price. We got this one like 48, and we're already up $20 in this one. Like we discussed this. I forget when we discussed it. We did a podcast where I was going through things that were undervalued, and like these both of these were on the list, BKH and ES. Like they were super undervalued.
Hopefully you didn't miss out on that.
This next one I actually didn't. I don't have the proper. Next one, PFE, which is Pfizer. I don't actually have this over here. We just sold this on 11/30.
I was just going to ask you about that because we had discussed this a couple of times. My spidey sense was going off about this, and then Tim actually found some information that Pfizer is not going to be as AI
heavy
explorative, which I think is a very piss poor move on their part.
Yeah, they're just sticking to what got them to where they're at now with the trials and the research and development.
They're
not actually putting as much money, like BMY, like right above it is. They have a ton of money in AI. Moderna has money in, like all the other pharma companies have a lot of money invested in AI, and Pfizer's is the last by a lot.
That's a big red flag.
So Pfizer it got sold on 11/30. I don't know, and.
What was our profits on that one?
We made...
or you don't know?
I have it in the chart. I think it was like 39% or something like that. It's on the email.
So,
it was close to 40%. It yields 6.5, and you could make money in 2025 if you want to have like a relatively safe moneymaker for 2025. But this one is like the same as Verizon. It's on its way out. Like it's the writing's on the wall unless they do something drastic in the next year.
Think about Uber and taxis. Like,
so you can buy it up to $30, which will lock in a 6% yield, and it pays out pretty well. We made $54.50 for we had a lot less in this than we had in these other two, and we accumulated 6 shares at almost $185 for the year. So it's been okay, but the price appreciation, we got this one for 22. And it went up. We sold it at 27, so we made $5 in price appreciation. So I was like, get rid of it. So I did.
There's better stuff to put it in.
Next one is BSM. We discussed this one before. I like BSM. It's a precious metals, mineral, exploratory type of company. It yields 9.75, but I've been getting this one in cash the entire time. Like I don't trust it enough to get the dividend reinvestment.
What do you mean you don't trust it?
Because it's just something about it. I can't like the financials.
Oh, is it one of those Oracle thingies?
Yeah, the financials are okay. The
So
debt pay down is okay. The revenue growth is okay. It's like everything's just like C on it. Like it's a C.
So you want to get your initial investment out.
So I'm getting my initial investment out. Once I get fully get my investment out, I'll turn the drip on and just see what happens.
It's the way to go, man.
We've only made
zero risk.
$164 on it this year so far. So it's not. The next one is we sold it in the van life one. It might be sold. I have a sell limit order in for the retirement one. I love the company. In any other political environment, I would never sell this one. This one is a Norwegian oil company. EQ.
Oh, and I love Norway.
EQ&R, and it yields a ton, 12.3%. And it's undervalued. You can buy it up to $27.50. It's at $24.40. Vastly undervalued. The experts say $35, $38 range, so you can make 25% on it. But it's Norwegian oil, and in 2025, Norwegian oil is not going to be as popular as American oil. So it had to go, and it's on its way out in the retirement. It's already been gone.
That's a tough decision. But that's where your macro climates.
Like, so we made $35.63 in November, and we made $197.23 for the year. Only got 1.1 shares. We only held this one for I got this one up at a discount, and I was like, I got a discount. I'm awesome. And then the election happened. I was like, so that was that one has to go, because the next one below it's way better. It doesn't yield near as much, but EPD yields 6.24. It's undervalued right now. I'm overvalued right now, but I think once the numbers start coming in, because EPD is pretty much, I think 85% of EPD, or maybe more, is all American. This one's going to explode. Same as, like I said, ExxonMobil, Chevron, all the American companies are going to explode. So you're going to get 6.24 plus the price appreciation. We don't know. I would say $45 to $55 range is where we'll probably settle in 2026.
And I don't know if we've ever talked about it on the podcast, but last time Trump was president, steel companies took off. My brother works at AK Steel, or I think they renamed it. I forget what it's called.
Cliffs now.
Cliffs out in Ohio. And
Cleveland Cliffs or whatever.
Yeah, so EPD I think kind of falls into that same category where.
Yeah, so this was a really good one. I like this one. You could $31 is to lock in a 6.5% yield, but you could, up to 35 would be more realistic. That would be a 6% yield. Dividend, it's grown its dividend for 20 years. Its dividend's not going anywhere. Its profit margins are awesome. Everything about this company is awesome.
Also, it's like a champion or whatever.
We made $54 in November, and we've made 107 so far. We've reinvested 3.6 shares. We've only held it for 6 months, and we were already up. I want to say 28%. That sounds about right. We got this one pretty cheap too. We got all of our oil stocks on sale because oil just tanked in July, August, and September. So
Tim was like, "Oh, shopping spree."
Actually, no, they were. But it's been bad. It's been down all year. I expected energy to perform better in 2024, but it wasn't one of my calls last year saying oil stocks will be good.
Well, until the Trump thing happened,
I expected oil to perform better, and when it didn't, I just started picking up whatever I could find within reason. The next two are municipal funds. So these are tax free.
Even though it doesn't matter because it's a retirement account.
But they've done quite well. We've made 15% in that one, or 18% in that one, and we've made 18% in both of them. So the fact that we've made 18% in these next two is crazy. This is like making 30-some% in bonds, which we've done.
We've done numerous times.
Numerous times.
Yep.
Municipal bonds, if you're not familiar, they basically go to cities, like whatever city you live in, they say, hey, we want to fund a school. We're going to borrow money from the taxpayers to fund the school, and we're going to pay it back within like 10 years. It doesn't have a sexy yield. It's only 6% yield for both of them.
That's a lot, though, for a bond type.
But these things have grown so much. Like we got this one at 11.28, and we got this one at 11.35 or something like that.
You know, I bet you people offload these things all the time because they see something more shiny and they just like bail ship, and then the price goes down and Tim's like, scoop.
They only pay 6% or no 8% per share per month. So it's going to be little. It's like $13, $12, $13, $12, $13, $12. But it adds up. We've made 87 in the one and 81 in the other one, which is 7 shares in the one and it's almost 6.5 in the other. And they just steady. Well, they're not volatile. So they're perfect for an income portfolio.
Yep, perfect. And if you are in a taxed portfolio and live in the state that you get the bond or the muni in, you actually get tax exemption or tax favoritism. So you can actually increase your yield by, reducing the tax component, which is phenomenal as well.
That's those. Okay, the next one, TRMD, another American one, yields 28%. It's at 21.09 now. You can buy it at 25 and lock in 25% yield. This one's good. This one's going to be worth a lot of money in 2025, 2026. So I would actually, this would be of this portfolio, this would probably be one of my top 3 recommendations to buy. We made 95.40 in September, and we've made that's all we've made. We've only held it for I think 5 months around there. But we got 3 additional shares. So this one's really good. Basically, I believe they transport petroleum. Like not like you're thinking on a boat. They transport it through pipes and things of that nature. But they're pretty good. Next one, and I don't know when they're going to pay dividend next, but when they do, it'll be probably 5 or 6%. It's SBSW. We got this for $2.98. It's already up to $4. Like her mom has the best luck.
She does. It's fantastic.
It's one of the biggest mining companies in America, and the fact that it makes like 12 or 15 billion per year and it's trading at like penny stock status is crazy.
Why does that thing have a 0 yield?
Because I don't know what the next.
Oh, is it variable? Mm-hmm. Oh, okay. You should just put NA, not 0. What the hell is that?
But this one's a complete value stock. Like if you think precious metals are going to be all the rage, which everyone seems to think they are, I'm not so sold on that. But I've preemptively got this one just in case for $4. Seriously, it was like $3 a share, so I've already made 25% in this one. It's ridiculous.
Oh. Gotta love penny stocks.
Next one's Vail. They deal with iron pellets, and iron's going to be super important for like
steel
infrastructure and everything.
Yep, steel and infrastructure.
It has a 14% yield.
Holy crap!
$9.87 current price. $12.50.
Steel pellets.
Iron ore pellets.
Iron ore pellets. Oh my god, that's hilarious! 14% yield.
We made $27 in September. We get paid again into this one's irregular. Like it pays out in March and September, or like April and October. Like it only pays out twice a year. But for 14% on something that like this thing should be in the 20s, maybe even the low 30s, the fact you're getting it for $10 is crazy. So we only made 27 and we only made 2.7 shares. But I'll probably hold on to this one for at least until the majority of the infrastructure projects in America are done, which will be 20 or 30 years.
Oh, you actually have bullet shares up in here.
Yeah, bullet shares, the next one. There's like 26 of these, so you can pick between whichever ones you want. For her mom, I had the 7%ers, which was a BSJW.
I was going to ask you how to pick.
2029 is the year that all the bonds they hold
I think we should do an episode at some point on how you pick your bullet share.
I just look at like the maturity year. I don't want something short term. I want something long term because they're less volatile than the shorter term ones.
They look like they paid more yield too.
They do.
So you get the best of best. So I don't even know why. So this one,
there's not a buy up to price. You literally, anytime you have cash and you don't have anything to dump it into, you just take your cash, buy bullet shares, let it accumulate.
These things barely fluctuate, so it doesn't really matter when you get in.
Because we made 15, then we made 20, about 25, then we made 23. Because every time I have cash, I put it in the bullet share, and then if I see something I like, I take it out of the bullet share. So this is just all over the place. But it is what it is. Almost done. Last one that I have on the page, and I have then I'll tell you where we've been actually taking our money and putting it into. STW is a REIT. They hold a lot of physical properties, but they also have mortgage notes, whatever. They buy debt.
Paper.
For 2025, if you like REITs, you need to look at the ones that actually hold paper. They can be mixtures like STW. STWD, where they have like 60% physical houses and 40% paper, but like they need to be mortgage REITs. The physical REITs I don't think are going to perform as well as mortgage REITs. And if you want the most yield and the most appreciation, you want to be in mortgage REITs. That said, this one is a little bit overvalued, but you could still get in right now. I have $20 because that gives you a 9.5% yield. If you do $21, you're still getting like 9% yield. So like it won't hurt too much to go up to 21. We made one dividend, 50/40 on that one, 2.5 shares. And that is all of our dividend stocks. We made in the month of September, we made 19.26. Month of October, we made 10.50. And the month of November, we made 16.34 for a total of 46.11 for the quarter.
Kind of slacking off with that laddering there, aren't you?
So how did we perform compared to the last quarter? Well, the last quarter, we made 42.52.
What was the quarter for this one? 46.11.
So we made more. So we had dividend increases and higher payouts. So when we went up like $400. This one's, stay tuned to next week. You want to see some crazy This one's, that's why it's a conservative portfolio, because
this is the conservative
this
portfolio.
one only like, doesn't seem like a lot. 250. It's like, what, 4%, something like that.
How much does he have in there? I forget.
182, 181.
And she's making whatever that is a quarter.
So she's making about, because we're going to tack on another, so it's going to be about 20,000 on 180,000. So she's making about 11%.
11.1.
11.1% on her dividends, her yield for the year. What we've been doing, by we, I mean me, and just I bounced off her and she goes, that sounds great. So no help.
You are so full of crap. I fight back when I actually have a reason.
I've been getting cash in a lot of things, and I've been selling bullet shares, and I've been just collecting. I've been like a dung beetle collecting cash. I just initiated a position.
So you have a heavy cash position in this portfolio? I
did. I just initiated a position in AIPI. I wrote about it in the email. What AIPI is, if you've listened to us long, you know we're in FEPI, which is in the Van Life portfolio. Basically, they hold a collection of stocks and they write covered calls on them. What AIPI does differently than FEPI is AIPI only holds artificial intelligence stocks. And artificial intelligence is in its like the first inning of a baseball game.
I don't think,
We literally have just about crested the part of the computer chips, the processors and things like that. We actually haven't even started the practical application of what they're going to do with artificial intelligence yet.
Yeah.
So I think AIPI, and it yields, I want to say 30 to 35%. So you're getting all the. They're basically buying up shares in all the best AI companies they can find that are good valuation. They write covered calls on them, and they pay you 35% for the year. So I've been saving up money in this, in the retirement account and the bullet shares, so that I could actually dump it into that. And I just did that. So in the next time when we revisit this in March, the first week of March, AIPI will be on this chart, and you'll see what it's done.
Yeah.
It's really good.
And if you guys aren't on our email list, Tim has been dropping these growth humdingers and stuff. Like, I'm just saying. But if you don't want to sign up for the email, I did actually just spend the last 2 days, and I'm archiving all of them actually on our blog. I will put a link to the actual category page for that if you don't want to sign up. If you do, you'll get them, you'll be the first to know, basically. That's how we're going to do it going forward.
I can tell you is her mom's account, her mom's portfolio is what I can classify as conservative. If you remember very back in the eons ago, we discussed like your risk tolerance. Like say you have a 1 risk tolerance, you're like, YOLO, I'll just put money in anything. Or you have a 4 risk tolerance, you're like, I'm only going to invest in CDs and bonds and things like that. I put this portfolio in the 3 area, which is it's really conservative. I have a lot of things in here that I wouldn't hold in an aggressive account.
Okay, so now my question here is, what is the typical yield on a, maybe not yield, but growth, whatever increase on a conservative portfolio typically? It's pretty low, usually,
it's
right?
like 8 to 10%.
So she's right at the high end.
She's making 11% in yield.
Yield, I know.
She's up. This portfolio is up 18%
in value.
In value for the year,
plus the yield.
So you have 11% would be the yield, and so 7% would be the appreciation. But like the total return is about 18.9%.
That's phenomenal.
Which is really, really good for a conservative portfolio. And there's nothing like too risky in this other than Icon.
But that's gone now.
and Pfizer, but we got rid of that. Like there's nothing risky in this. Like the risky stuff, like say people think that the yield maxes are risky.
I was just gonna say, because the yield maxes that we're in, like NVIDIA is maybe the riskiest of them, because the other ones are like index ones.
Like if we went through the risk mitigation, if say you put $5,000 in NVDY, 5,000 will get you, I don't know, we'll say,
do I want me to do math?
Yeah, do 5,000 will get you what, divided by 2480. 201, 202 shares. Well, you're getting like $2, between $150 and $250 a month on 200 shares. $2. So you're getting $400 in cash. So rather than take the cash and reinvest it back into NVIDIA, just take the $400 and put it into your bullet share. And then once you hit $5,000 with your initial investment of NVIDIA, then you can turn the drip on and start accumulating NVIDIA shares. But you've already
That would take you just over 12 months to get your initial capital back.
You have mitigated the risk because you've taken your initial purchase price and you've put it into cash, which you dumped into other better yielding stuff. You haven't actually sold your NVIDIA shares, so you still have 202 shares at the end of 12 months. You've paid it off, so it's all profit.
So it's a cash cow at that point.
At that point, yeah, it's just like having a renter.
Having a renter, buying a gumball machine.
So that's how we make these three here
not risky.
Not risky is we take the cash or the dividend as cash, we pay them off,
and then we let them ride.
Then we let them ride, and then we just. And
you can either increase let them drip from there, or you literally can just keep it as a cash cow.
But then in the context of everything else, like it's $180,000 portfolio. She has, I want to say, $3,000 here in NVIDIA. 3,000 here in YMAX and 2,000 in YMAX. So she has $8,000 total of $180,000 in what, quote, risky assets.
That is only 4.4% of the portfolio.
So 4.4%. So the yield on the portfolio will cover the risky assets. 11% yield, remember, we just did the math. This is 4% of the portfolio. So worst case scenario, you're down a couple $1,000, but you're collecting a crap ton of money because she's making, if you look at what she's making. And again,
you reduce the risk if you turn the drip off.
What she's making a ton of money in these three.
Tons.
For what they are.
And I know we keep saying this. We're going to keep saying it till you guys get it. Like, this is a phenomenal opportunity. Like, screw crypto, honestly, at this point.
And except for 2025.
Well, but I'm saying, like, from a cash generation perspective.
Crypto's more of a get-rich-quick scheme.
If you freaking find the right ones, but they change, and then the infrastructure's so jacked up, and Coinbase is a freaking... don't even get me started on how crooked that thing is. For a retirement
portfolio or a travel portfolio, I'm under the belief that you have to have some exposure to these because you're getting these percentages in return.
Huge. Like screw junk bonds, I guess I should say. Screw junk bonds.
I didn't even cover the bonds. Like her bonds are like.
Oh man, are they even in here?
I'd put them in here. Like she doesn't like her bonds. The like ridiculousness. Okay,
go over.
Let me get this up here. She has the bond in Altria, which pays 4%. She makes. She's made $89 so far this year in the Altria bond, but she's up 40% in the bond because we got such a good price. When I was beating the table. On bonds, I said, buy bonds, buy bonds, buy bonds. And everyone's like, but bonds aren't popular and nobody likes bonds. Well, she's up 40% in this one. She's up almost 30% in this one.
Mylon.
Without even including
the dividends or the coupons or whatever they're called. Yeah. Coupon payments.
So she's doing quite well. Like she's doing quite well on everything.
So we're just like, whatever. You can not buy bonds. We'll buy all the bonds for sick. You.
But next week will be the fun portfolio. This is the boring conservative one.
Yeah, ours is going to be a lot of fun because Tim gets to do more risky stuff because I'm like, whatever. I'd do it too.
So that's that. I hope you guys enjoyed this boring, long discussion on numbers.
It's not boring. It's great to see, I think, to see in detail like each month. And then again, they might seem small, but when you add them all up, you make a freaking whopping thing. And this is exactly how you basically can like secure your finances and liberate your life.
Yeah. See you guys next week.